Hi, good morning, ladies and gentlemen, and welcome back to another terrific Thursday tip. Today, we're going to talk about what some of the CEOs, big CEOs, are talking about, what they believe is a risk on the horizon, and how they are preparing their businesses to handle this. So, I want to dive right into one of my favorite CEOs ever, and that's Jamie Dimon from JP Morgan. He basically got on CNBC and just talked about how inflation is eroding everything. He believes that there's about $500 billion in personal savings that will probably run out mid next year. So he's looking out for those things that very well derail the economy, cause mild to hard recession. So he's obviously worried about it, but he also talks about the geopolitical risk, kind of regarding Ukraine and China. The upheaval, including the war in Ukraine's trade with China, are among the storm clouds that Diamond is watching. As the dollar strengthens, he noticed that international trade for something like oil will continue to be more expensive since weaker currencies are forced to match the difference. Now, for those who are not aware, that the oil market is run off the US dollar. And if you've been watching kind of the currencies, you'll notice that the dollar is at its highest level. And while other currencies like the yen and sterling have all kind of reached their all-time lows almost per se. So what they have to do is then, take their currencies and then buy dollars with it, which they're already losing money on it, and then go into the oil market to buy their oil. So that is causing some trouble. So he definitely thinks that oil and energy will definitely be going higher because of the strength of the dollar. Our next CEO is Mary from General Motors, and she took a more bullish perspective. She anticipates economic headwind next year, but is not sounding the alarm just yet. If you watch my later videos, I talk about the demand for cars and new cars and how the pandemic sprung such high demand. Well, basically, she was saying, during the pandemic, they were caught off guard because they didn't realize demand would be so strong. So it's now the other way around for her. Um, Even so, the car manufacturer is proceeding with caution to be prepared for a potential collapse in demand, similar to what other industries have seen during the pandemic. Like, for example, you look at airlines that completely shut off demand, and they had to, either raise capital just to survive, or lower costs, or just kind of wait it out. When consumers were spending less on travel and service, some industries saw elevated demand. For example, I like to use this, even though I'm not a big fan of Peloton, but a lot of people had Pelotons in their house because it was a workout at home environment. So she doesn't want to be caught off guard. She's fairly conservative for 2023, cost wise, to avoid being blindsided, but that she's still seeing pent up demand lingering from the pandemic. So there's still money out there for cars. It's just, is it at a tipping point? And that's kind of what we are trying to gather from all these CEOs from different industries. So we even have CEO Doug McClellan for Walmart. He doesn't want a recession, but he thinks it might be a necessary evil to ease inflation for his customers. So if you're familiar with, you got to be familiar with Walmart. Walmart has these low prices, and it kind of fits into the people that go from paycheck to paycheck. And he's even seen, a decrease in demand from his current customers. But it's weird because you think about it, if let's say I'm in like a middle class and inflation is really eroding at my purchasing power, I might be starting to shop at Walmart. So it's kind of a pro for Walmart. Interesting that he said this thought, but we'll see where he goes. We got some customers who are more budget conscious that have been under inflation pressure for months now. Should the Fed do what it needs to do, even if it's a much harder landing, he believes that that is the best route. So he's obviously pro on trying to get inflation down. And then because he's seen a lot of his inventory, a lot of his high margin stuff is not selling as opposed to his low margin stuff. And that's where he's coming from, I believe. We even have United Airlines CEO Scott Kirby told CNBC that his company is entering a year with optimism, but that 2023 might see a mild recession induced by the Fed. So obviously, higher interest rates are really affecting prices, and they're trying to lower it and lending and all that stuff in the economy. But business travel enjoying a steady rebound. So we're obviously seeing people go back to work. So United is kind of out of this pandemic era. Like I said earlier, they were one of the main people that saw demand completely collapse during the pandemic. Um, but he does believe that travel demand is plateauing, which might indicate pre recessionary behavior. So people are holding back on their travel, not spending as much. It is worrying to him. Let's jump to our next CEO. Lance Fitz of the Union Pacific Railroad told CNBC a sign that consumer spending is tapering off and the economy is tightening. The housing market has clearly slowed. One, that could be due to the interest rates, and that's definitely what's happening. And parcel packaging has clearly slowed, as we are seeing that in paper and parcel shipments. So no, not as much demand. And I even heard this today that basically FedEx, the CEO announced that basically half of his planes are coming back half full from China. Inventory's not there. Demand is kind of slowly starting to taper off. We even have Mr. Solomon, who is the CEO of Goldman Sachs, and he gave a more kind of bearish kind of perspective, but is well aware of what is to come. Stocks and residential real estate to be lower a year from now. He gave a 35% chance of a soft landing where the Fed can curb inflation without pushing the U.S. recession. I personally, I don't think there's going to be a soft landing, but it's great to get some clarification that it's a 35% chance from a super stud like Mr. Solomon. But there's also a very, very reasonable possibility that we could have a recession of some kind, he said. So he's very aware. All these CEOs are very aware what's coming on the horizon. In 2023, they're cautious. Now, I wanted to show this graph because I think it's important. There's a couple, three areas I want you to look at. Obviously, in blue, we have the unemployment rate. In red, we have the personal savings rate. And then we have our CPI minus food and energy. So, before 1975, we saw, inflation rise. And then what followed suit? Well, we saw personal savings rate decrease, kind of like what we're seeing right now. And we also saw the unemployment rise up as well. And this has been a kind of a trend lately. And if we look at multiple areas like in the 1980s, look at unemployment rate was low, inflation shot up, unemployment rises, and then the personal savings kind of plateaued for there. But what's really scary for me in my mind is that when you look at where we are today, we see that inflation is rising right here, but we kind of plateaued before pandemic on the unemployment rate. And when we have interest rates rising and we have layoffs coming, and you have big CEOs who are incentivized by their stock prices and their bonuses to perform well, they're going to do cost cutting backs to make sure that they are still turning a profit. So right now, I think we're at the very tipping point of where we're going to see probably a lot more layoffs. We're going to see inflation kind of erode this purchasing power that people have. And we already see it. Look at the personal savings rate. It is pretty low. It's almost back to its 2005 levels. These are concerning because does the consumer have enough money to withstand the current inflation? And are businesses going to use cost-cutting measures to make sure their profits are leveled up? And of course they are. So I definitely expect this unemployment rate to rise here and within the next year. I also want to take note of basically what is called the Conference Board or Consumer Confidence. And then we also have the University of Michigan Consumer Sentiment. So anything above 100 is, there are more jobs prospects, there's personal finance and intentions to spend. So there's more of that. But over 100 has more consumers with positive rather than negative sentiment. And there's a big gap right here. I love using Michigan because it kind of gets a sense of what's going on in the United States. And Michigan already has a 56, so which means that consumer confidence is eroding pretty quick. And I expect confidence boards of consumers to follow suit with the Michigan study. So we are seeing the consumers' confidence completely not be there, and it is worrying. And I think these are important areas as consumers and people who are paying attention to the current finances, that there might be some trouble on the horizon. I personally believe there's going to be a lot of trouble on the horizon. The facts are adding up, the red flags are showing. So I just want my viewers and clients to understand what is coming and how to prepare. So I would take the advice of these major CEOs, and I would really take it to heart. Anyways, thank you so much for watching these Thursday tips. As always, thank you and goodbye.